Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. In today's episode, we unveil the metrics that Tim uses to narrow almost 20,000 stocks down to a couple hundred. Then a little bit more research reduces that number down to a select few that you can invest in right now. Tune in so you can implement this ideal screener to kick overwhelm and uncertainty to the curb forever. Hiya! All right, so today is the day that we're going to talk about the screeners. And the reason that this is super important is because you do not want to have to be individually, painstakingly researching and deep digging into.
This is probably the most important preliminary thing you'll do before you actually research anything.
Yeah, and it narrows it down. So it's like, if say you're looking for the color red and you just dump a whole bunch of crayons on the thing, you obviously are going to take anything out that's like a remotely good like red shade, and you're going to get rid of the whole other pile of stuff before you determine like what color red you're actually looking for. So it narrows the ginormous unmanageable amount of stocks down to the things that are probably going to be contenders when you go to do research, so you don't waste time.
You still have to do research. I can't stress that enough. Like, this will narrow it down, but you still have to research. You can't just rely on these metrics and say, well, that's a good one.
I mean, you may be able to get to that point if you really get crazy, but Tim only has 4 specific things that he does to run it through the screener.
Or you might have 6, you might have 3. Like
if you're a nerd and you really want to be able to spit out exactly what you want, you can get real crazy with this. That's not Tim's approach. Tim likes to just narrow it down using these 4, and then he does...
It's my starting point to then do deep dives into different things. But I can kind of, after you use it long enough, you'll be able to like look at things and be like, oh, okay, that... If you do enough research and deep dives into things, you'll be able to know that tobacco has like a PE of around 8. So then you can just cursory glance at Philip Morris, MO, Altiria, British Tobacco Company, and be like, okay, well, their PE's 9, so it's above 8, so I didn't have to look at that one. But that comes with time. That is not something that you're just going to be able to do right out of the gate. It
comes with experience, it comes with time, it comes with knowing what you're looking for, and it's like any other skill that you end up honing. It's you got to go through the baby steps, you got to build the foundations, and then once you're immersed in the day-to-day with investing, you'll start to see the familiar patterns. You'll start to notice like, oh yeah, I don't care about this stock. Like, what's one, for example, you'll know that'll pop up that you're like absolutely not interested in?
That one right there, Ellington Financial. I know that's a company just without even having to look at it. I just know that's a company because it's a BDC, and I spend so much time in BDCs with all of my other stuff that I know that one's garbage compared to the other ones. Okay.
Now, is there ever a point that you would reevaluate it?
Yes, but if this went down, if that was around 20%, if this was better than 0.33, like 2 or 3 years from now, say this is at like 5 or 6, then I'll be like, oh, okay, I can look at it again. So, like
I said, Tim's comfortable with using just 4 metrics to screen thousands of stocks down to like this thing just spit out 139. That is very manageable compared to thousands.
Yeah, there's 19,500 potential stocks, bonds, ETFs, blah, blah, like. So combinations just in American stocks.
And you do this every week?
No.
Month, quarter?
I do it every quarter generally.
Okay. So
see if I'm missing anything. But then like I'm comfortable with the portfolio, so I haven't done it in 4 or 5 months because I don't need it. Okay. It's when I generally like if I have say I had $10,000 in bullet shares, I'd be like, well, I need to put that in something that yields more than 7%. So then I would screen
to find opportunities.
To find opportunities, yeah.
Okay. So you're going to be prompted to go and do this. But like if you were doing it on a specific time regimented basis, say it's quarterly, you would not want to have your screener shoot out a high number that you cannot possibly research in the time it takes you to then have to start the process all over again.
And every brokerage has its different version of a screener. I use Schwab because I find Schwab is the easiest to get what I need. Like Vanguard, as much good things as I hear about Vanguard's crap for pretty much everything other than trading.
And we actually are going to do an episode on different brokerages because
it's just
I have so many people asking about that, and it's like, well, your metrics this that, but we found a really good article that talked about,
like, for example, I'll show you, like, so this is how inefficient Vanguard is. Say you want to research IBM. If you type in IBM in the search bar, it'll bring up 15 different things to choose from. So you'll click on IBM, the company, and then it'll bring up like the primary that ticker page, and then you'll actually have to click on more information on this stock, and then you'll click on that, and it'll take you to a completely different page that you then have to scroll down through like 1,000 things. Like, it's very inefficient. You literally have to go to a different page and then have scroll to find what you need. It's just, it's awful. I don't like Vanguard at all.
From a research standpoint.
From a trading standpoint, it's all right. I mean, we're not discussing that, but it's like 15 minutes behind. Like, you can't trade at like 9:30, like when the stock market first opens, because the prices aren't accurate.
We'll go over that when we actually do the comparison between different brokerages. But the gist of this is we are choosing Schwab to do the research in because it spits out in the screener a very nice, concise spreadsheet looking thing for very easy filtering and ability to just rule out and narrow it down and then move on to the research phase. You want to be able to do this as fast as possible, save yourself time, save yourself energy.
Because the long slog is when you have to go in and research individually. So, like, you want this to be
quick and dirty.
Merely like 2 minutes.
You literally want this to be quick and dirty. So, my question to you now is, we've been talking about there's 4 different metrics. Why do you feel that only 4 metrics?
Because I through the years, I've been through multiple different metrics, and I've settled on these ones because they generate the list quickest that are probably undervalued.
Okay. So undervalued is like the highest importance for
as a contrarian, like we preach about contrarian investing, value investing, income investing. Well, to be a contrarian value investor, you have to find undervalued things, and to find undervalued things, they have to be close to their 52-week low, and they have to have a lower PE. So, like, that's 2 of the metrics I use.
We don't really do the screener unless we are looking to diversify or to buy different stocks. So using that as the criteria, if you wouldn't have that as one of the criteria, they wouldn't even be in the buy range for our own criteria, correct? If we weren't putting that low value thing in?
I probably wouldn't find them because, like, seriously, there's like 20,000 different things to look at to I maybe might find them, but like.
And that's the thing, because he just pulled this up and I'm looking at it and it's got like hundreds of different options that you can put in for the screener, and making it easy, making it simple, making it efficient.
You could probably have a million different combinations between what your criteria is that you're screening for. And I've done probably 50 different screeners through the years, and I just stumbled upon this somehow. I got lucky, and then I was like, well, that worked way better than the last one. So basically our suggestion is start with what we're talking about, and then if you want to expand upon that and get more nitty gritty and nerdy and do whatever, you can expand and change the screener for yourself. The reason I didn't do more, though, is because I like I said, once I've narrowed the list down, winnowed the list down. Once I narrowed the list down, then I go in and research everything individually, and then I compare it to what we currently have, or what your mom has, or what the third portfolio has, and then I'm like, well, that seems like a good idea. All right, so enough intro crap. Let's roll into the 4 metrics. The 4 metrics. The first one is dividend yield, because we are looking for something that pays us income. Like, you could easily get into something that pays like 1%, but that doesn't pay anything. And that low yield. So what's your threshold for the yield? Well, because Schwab only has it, it's 4 to 6% or above 6%. There's only like 4 tabs. One's 0 to 2. Then the second one's 2 to 4, the third one's 4 to 6, and the fourth one's 6 and greater. So I do 6 and above. 4% or higher is basically like what I screen for the dividend yield. The second one is price to earnings. You have to have a general idea of what the overall market's price to earning is to have an idea what to put this at. I have it at less than 10 or 10 to 20, and I think it goes less than 10, 10 to 20, 20 to 30. And then 30 to 40 and 40 and above. So I just take the bottom 2. Mm-hmm. Then the third one is the percentage above the 52-week low. The reason being is the closer it is to its 52-week high, the higher probability that's overvalued. The closer it is to its 52-week low, the higher probability that's undervalued. Yep, that's actually a really smart way to do that. And you said that was like the gold thing you just stumbled on? Yeah, that was the one I stumbled on. I had all this other stuff before, but I never had the percentage above the 52-week low. And it has different category, like things you can click on. I do 0 to 20 because that means it's either at its 52-week low, below its 52-week low, or within 20% of its 52-week low. So that to me is fine. I like that. That sounds good. And then the fourth one is the 5-year dividend growth rate. Because we are contrarian value and income investors, we want the dividend to be increased. They have a 1 year one, but that's that could just be a one-off thing. So I settled on the 5%, the 5 year. I'm sorry, the 5 year, because that actually shows a somewhat of a track record for 5 years.
A consistency, a pattern. And the reason we want this too is like if they're not continuing to grow their dividend, they're not keeping up with inflation. And the whole goal of the portfolio is to continue to pay us for life.
It's that there's two primary reasons why I want it to be 5 year dividend growth above 1%, because like there's ones that have above 10%, but that then only gets you like 4 things in your list. So like you do want to minnow your list down to a manageable number to research, but at the same time you don't want it to just shoot at 6 different options and that's it. So you have to settle on the sweet spots where you get a multiple different things to look at.
Yeah, like if you have too many outliers, you might want to narrow your criteria down. And if you get not enough options, then you really have to maybe expand your search criteria.
And I use the 1% to 15% 5 year dividend growth. I find anything above 15%, like there are ways that they can finagle that to make it seem higher. Like they can pay you 1% dividend for 4 years and then have like a year where they just give you a completely crazy variable dividend where it shoots it up to 15 or 20%. And then again, at the same time, like as much as I like high yielding stuff, the probability is higher that if it's yielding 25%, there's something seriously wrong with it.
Yeah, it makes it way more risky. Well, I was actually going to ask you that. I was surprised that you're actually encompassing the 4 to 6 range for yield.
Well, that covers a lot of the utilities and
I was just going to say,
consumer goods and things
doing
like that.
The utility episode, you start to see that some of these, there's like trade-offs, and the ones that have like the muni bonds, even though they're only paying 4 to 6%, you have to take into consideration that tax-free aspect. So it actually bumps that up.
Well, that was one of the areas where I actually I've been tinkering a lot, because I used to have it like 6 to 8 or 8 to 10. But like I found like the 4 to 6 range seems to be the sweet spot where they have the best 5 year dividend growth rate.
Okay.
I guess if you're paying out too much in a year, you don't have the opportunity to raise your dividend every year. But if you're paying out too little, that means you're not raising your dividend enough. So I found the sweet spot to be 4 to 6, because then you'll get a lot of the companies that are really good companies that then raise their dividends 6 or 8 or 10%, 2 or 3 years, or 5%, 2 or 3 years. So like,
and that's awesome. That's absolutely awesome. It allows you to like keep up with inflation, keep growing that nest egg.
And if, like we've went over it before, if you're getting a 5% yielder, but you're getting undervalued by like 60%, and it's growing its dividend by 5 or 6% per year. So by the time it gets back up to where it should be, your total yield is going to be 8 to 10%.
Yeah, and I'll even say when I first started doing this or looking into this stuff, I was like, why would you ever pick the like dividend aristocrats that are only paying like 1-2%? And then it's the growth aspect. It's the fact that they continuously increase, sometimes up to 10%.
Oh, it's very seldom have anything below 4%.
Yeah. So it makes sense that, okay, the 4s make sense if they actually have a big growth. One we had was
Calm, because Calm was paying like 10%, and then it didn't do anything with its dividend for like a year, so its dividend was like 1.2% or something like that. Mm-hmm. And the other one's AFG, but that's one that gets mislabeled as a 2% yielder because it gives a special dividend every year. They don't actually encompass that in its dividend yield.
So that's actually what I was gonna ask you. That yield doesn't include those special dividends.
No.
I wonder if we actually miss any.
Well, probably.
But that would make sense that like going lower with dividend yield, you'd encompass then, or you'd find those like
Hercules Capital, for example, usually pays 2 out of the 4 quarters will give you a special dividend. We just got one for 8 cents. That 8 cents isn't actually included in its yield in most brokerages when you're doing a screener. And I don't believe it's actually included if you just look at the cursory thing in Yahoo Finance where it says Hercules Capital yields 8-some%. I don't believe that the special dividends are actually included in that either.
So my question would be, would that one come up in this screener?
It didn't, no.
So it would only come up eventually when it got close to its 52-week low then, probably?
Maybe.
Okay.
Possible.
And that's why Tim does do this on a frequent basis, because it's like we find stuff all the time that's something we didn't even know existed.
Always changing. It's always in flux. And that's like part of the beauty of this for me as a numbers nerd is I love that things change, that it doesn't get stale, because I'm always finding new things to research. Other people want stale. They want it to be boring, and that's completely fine. That's your...
Yeah, if you find your core ones, that's absolutely great, but you can't find them unless you go through these steps first.
I enjoy the actual always needing the research stuff and finding new things and revisiting things that I visited like 3 years ago. I'm like, oh, the company's done this and this and this in the last 3 years. Interesting. So,
like, for example, one of the ones that he brought up, I think, when he decided on this screener was the UGI, that other UGI stock that you found. Yeah, I don't think we brought that up on the podcast. So we did. It was right after we did the utility episode where UGI came up as one of his best picks for utilities. But then he was doing this screener and he's like, what is this stock? He goes, I've never seen this before. Okay,
2 of them. There was UGIC and AQNU. 2 of these I've never even seen before, but I've actually researched UGI and I've actually researched AQN multiple times, and I've never seen them before. They came up on the screener. UGIC is a corporate stock. What that means is literally you get none of the rights of the stock. You just collect twice as much dividends. So you're getting 12% with UGIC.
So it's almost like the preferred share, but it's not the same thing.
But they can call it back at any point. Yeah. And when they call it back, you don't get a chance to say I don't want it. They'll literally just convert it from UGIC to UGI.
And we like UGI, so we were UGI, like, there's no downside with this, right? And you said it pays twice as much as it paid for Yugi.
Yeah, twice as much. It was like 13%. UGI was 6.5. So
that's so freaking cool. Like, that stock's been out for a while, and we had no idea that was a thing, but it just popped up in the screener the one day.
AQNU is the preferred share of AQN. I never even knew AQ.
And had a preferred?
Preferred, yeah.
Yeah, because they are kind of hard to find sometimes, especially if you're not using Schwab.
Utility preferreds are very difficult to find. So if you're looking for a preferred share in utilities and you have a way to find it, dude, reach out, because I can seldom find preferreds for utilities. I know they all have them. They have to, because they're always taking on debt. So they have like bonds or preferreds or all like. But I can.
Oh, you don't know how to find them.
No. So what was I talking about? I forget. Okay. So I literally just put this stuff into my screener.
And it went from 19,000 down to 139.
19,500 down to 139. And if you use those 4 points, you have a very good starting point, because you then can sort them by however you want. If you want something that's more undervalued, you can click on the percent above your 52-week low, whatever it should be.
Okay, so my question is, now that we have 139 popped out of here, obviously that's probably too high, too many that you want to actually do research on.
You can get rid of a lot of them. You look over here at the 5-year dividend growth.
So that's exactly what I was going to ask.
This one.
What do you filter by? The closest to the 52-week low? The 5-year growth? Like, which one do you filter by?
It's a combination, because it comes up in this nice little matrix looking thing. I can literally you can go through. This one doesn't matter.
The annual dividend yield doesn't matter. The dividend yield
doesn't really matter. It's just a piece of information that's good to have. But it's these 3 columns, and you can look at them, because the PE, you don't want that to be close to 20. You want it to be closer to 0 than you do to 20, because that means it's price to earnings is
most likely undervalued compared to its peers.
The percentage above the 52-week low, you want that to be whatever the less than 20, obviously, because you do the 0 to 20, but like less lower the better.
Yeah, again, closer to 0 better.
5-year dividend growth, you want that to be the higher number. So like you literally could just scroll through this and you'd be like, well, this one here looks pretty good. What is this one? DMLP.
Oh, so it doesn't actually have a filter button where you can rank?
You can literally just
oh yeah, okay, so it does.
But you click on it
and it'll filter by that column. So you can filter all 3 of these and see what comes up. And if you start seeing, take the top 10 or the top 20 in each one.
Then you can oh, that one's cool. Look at that one. That one's
DMLP.
DMLP. Some mineral company. 11% yield, 10.96 PE, 17% above its 52-week low, and 14% 5-year dividend growth. That number's a little high. I'd prefer that to be lower, but I mean, that's a good starting point.
The percent above the 52-week low?
Yes.
Yeah.
You just keep, then that's all you do. And then you literally, that was another good one. Glad.
I've heard of Glad. I think it's been in the emails a couple times. MO came up.
Oh, there's a really good one right there.
DC.
OCSL.
Oh, that's an O. I need my eyes checked.
Look, anyway,
So do this for yourself. Go into whatever your brokerage account is. Run those.
What you'll come across is like BMY's on the list. Bristol Myers, it only has a 5% yield, but all the other numbers are fantastic. Chevron came out on the list. It only has a 4.3% yield, but all the other numbers are fantastic. BTI, MO, MPLEC, MPLX, LTC, OCSL, GLAD. There are ARCC, which has shocked the shit out of me, because that's like I think that's the biggest BDC. But like you do this and then you'll have a place to start. And then you do like what I do is I open up a spreadsheet and I'll be like, well, that one looks interesting. So then I have a spreadsheet of stuff to research after I go through the list. And then I just individually search everything to make sure that the revenue's growing, the debt's going down, profit margins are going up or they've been stable. And it's simple. Once you actually narrow the list down, it's simple to do the research once you establish the metrics that are important to you. I find personally the ones I just mentioned are super important. The revenue's going up, debt's going down, and the profit margins are going up. The reason why revenue obviously means they're doing more business. Debt going down means they're not going to have to pay off as much debt. And profit margins going up means they have more wiggle room to raise the dividend more.
Those aren't the only things you look at, though. You kind of get a general picture for everything when you start digging in, because it's like sometimes if they know that they're taking on debt, like Camping World's a really good example of that. They're taking on a lot of debt with the intention of pushing a lot of growth, so that makes sense. And if you believe in the company doing what the company's doing for justified reason, that might not be something to not invest in,
the Camping
but to
World
keep an eye on.
would be on that list because the 5-year dividend growth.
Except that it cut it, but yeah.
No, I'm just saying, like,
Yeah.
like that's why the screener I have is freaking awesome, because generally you won't have to even worry about researching something like that, because the 5-year dividend growth with all the other 2 columns, the dividend yield doesn't do the other 2 columns basically weed out all the ones that have cut their dividend and within the last 5 years, because you're not going to have a high percentage of 5-year dividend growth if you cut your dividend.
That's a valid point. So it takes 2 minutes to run the screener. How long does it take you to actually skim through the screener to pick, I don't know how many, 20 stocks or something to research?
30 minutes.
Okay, so 30 minutes there,
Depending
and then...
on the sub-list size, like that one, the 140 would probably take 15 minutes. I've had some with the same screener shoot out like 250, and that took 30 minutes. Like it's doesn't take long. Like you literally will have 5 or 6 decent things to buy within an hour.
That's really good turnaround time. Like really, really good. Versus trying to spend time listening to these talking heads. 10 different people can tell you the exact same or completely different things for the exact same ticker. If you go in and you do the research yourself, you have the actual data, you have the facts right in front of you.
Well, that's why I've always said, like, that's why I say no one cares about your money more than you do, because if you just do the research yourself, don't rely on anyone else.
And one of the best things and the reasons that we rely on this method is if you've ever seen a quote from something and then you actually got hands on the original thing that it came from and you read it in context and you realize the context completely changed the intention of whoever the heck quoted it out as, right there is a prime example why you should always go to the actual metric data yourself and interpret it like in its raw form if possible.
Mm-hmm. You should.
When you do the research component, you're saying you can go through 139 in 30 minutes even from the research component?
Yeah.
That's fantastic. So the only thing that takes you super long is going through the earnings reports, right?
For the most part, because like once you get in this list, you can click on we're on 5 right now.
And guys, like what he just gave you could probably be worth like thousands of dollars in a course. Like no joke.
Like I found 6 like within seconds. Then you literally in Schwab you can compare.
Okay, so in Schwab, what it gives you is it pops this 139 up, and you can actually click a box, and then at the very bottom, any of the ones you clicked,
5, you can go up to 5. You then can compare up to 5,
and you can compare them. You just click the compare button, so that's really cool.
The actual research doesn't take very long. It's just because
knowing what to put in.
You need to know what you're looking for.
You need to know what to put in, and I think coming up with the actual screening metrics is the hard part.
Well, that's why like we've given them.
Because how long did it take you to come down up with all like this specific thing? Years.
It probably took 3 years to come up with this screener with these metrics and the data points I look for when I do individual like deep dive research and stuff. It took years.
And if that was a little fast for you guys, I am going to do like a quick summary of what we look at in the show notes. So you can just be like bullet, like checklist.
It took years and years. I mean, it was enjoyable, so I don't care. But like, I could see how it could be painstaking for other people.
Yeah, especially if this isn't.
You can compare up to 5, and then it'll pull it up, and they'll like give you. You can find the profit margin, the revenue, all that stuff when you compare it up to 5. So it's Schwab's by hands down the best research of all the brokerages.
So if you're big into research, we definitely recommend Schwab. But we will do a comparison of different brokerages in another episode.
But you'll be amazed if you use what I just gave you. You'll be amazed what you can find, and they're like. Good company, like I said, Bristol Myers, Chevron.
Aren't those in the dog of the Dow? Chevron was, right?
Chevron is.
Okay, that's why that's
Philip Morris. Alteria.
UPS?
UPS, yeah. Black Hills Utility,
LTC.
Guild. Like, you'd be amazed at what that list will bring up. Like, quality companies
that you don't really hear about being pushed because they're kind of flying under the radar usually when they're undervalued.
The way to get the quality companies literally was the 5-year dividend growth, and I had to drop that down to 1 to whatever it was, 1 to 15%, and I had to drop the yield down to 4 to 6
to find the sweet spot.
I didn't have the 4 to 6 before, and this list wouldn't have had any of the really good ones. Bristol Myers wouldn't be on there, Chevron wouldn't be on there, BTI would be, Philip Morris wouldn't, UPS wouldn't, Black Hills wouldn't, Guild wouldn't. Like, it would have literally made this list still decent, but it wouldn't have been awesome.
Well, I know the Black Hills one's one of our favorites.
Love it. It's been growing its dividend for like 60 years straight. It's grown at like 6% the last 5 years. It's right around, like, it's low. I think it's actually lower than that now. I think it's probably like 9% above its 52-week low.
Ooh.
And its PE is super low, and it yields 5%. So you get in at 5% knowing that it's going to grow probably 40%. So you're getting a 40% price appreciation, collecting 6% dividend growth every year on top of the 5%. So like by the time it gets back up to where it is, your actual dividend yield is going to be 8 or 9% on a utility. So it's awesome.
That's freaking Shazam.
I'm just saying, like, this makes everything so much easier.
So much easier. And then what we talked about...
It's like, I know when I first started, I was overwhelmed, and I'm a nerd, so I can't imagine what an average person goes through.
I was just going to say the overwhelming component, that is literally how you can get rid of needing to talk or listen to 10 talking heads. It's like getting rid of the uncertainties. It's getting rid of the extraneous crap. It is narrowing things down to a manageable level. Like, I don't know if you know anything about, like, starting stuff. I
can tell you that I've subscribed to hundreds of people, and I've paid for probably 20 different things, and I've never, not once have they told me what they screen for.
Yeah. They like to keep their stuff proprietary, and we're not trying to do that. We're literally trying to teach you the method.
To teach you the skills so that
you can go fishing for yourself.
You don't need to listen to me like 4 years from now.
We're hoping at that point you guys can figure random stuff out and feed it into us, because
although we'll
have
a different podcast at that point about different things. You might still want to listen, but this is actually quite simple once you got the screener information now, and then once you actually figure out how to do the research with like the revenue and the debt and everything, it's simple.
You're probably driving or doing other stuff, and it's hard to consume. So if you guys want this in video form, just like...
Yeah, we could make like a video.
Go into the show notes.
I could show you exactly what to click on in Schwab.
Yeah, go into the show notes or shoot us an email and click on one of the ways to contact us. Leave a comment and let us know. We will totally do that, because I'm not sure I would have been able to get as much out of this without being able to see it myself.
That's the screener. Like, the screener that's the most important part of the last 3 things we discussed.
And it's the shortest episode that we did.
It's the easiest. But using this screener, I came up with a list of 5...
5 what?
5 best potential investments right there. Like, it was in the email. Like, I actually composed an email
a couple weeks
back that had all this in it, and it brought up the 5 best: Philip Morris, Altera, UPS, OCSL, and NEWT are the 5 best based on the metrics that I would actually put money into right now. Well, at that point, it was the 13th. As of 2 weeks ago, but I know the markets went up a lot. But like, the beauty of it is if say you have a week where the stock market goes up like 8%, well, then on Friday, just do the screener and it'll bring up everything that's undervalued still. So You don't even have to worry. Like, you don't even have to worry about if the market shoots up, because it'll just bump off the ones that are like closer to their 52-week high, the ones the PE went up too much. It'll like, it's beautiful.
Yes, every time you do this, it'll literally screen for the real-time data. It's beauty.
It's actually beautiful.
It'll show you which ones, like, you'll see which ones you want to turn your drips off in, and then take that cash and then funnel it in, do the screening metric, find the ones that are low.
Once you do it and you see how beautiful it is, you'll be like, oh, that's beautiful. It really is. It is.
If this takes away your analysis paralysis and overwhelm, like, that in itself is totally worth it.
Beautiful. And then that's it for this week. That's short and sweet. Short and sweet, simple. Next week, I forget what I think we're doing.
Let me look.
My grandpa just died. He raised me when I was 12 to 18. Well, him and my grandma, but like, he raised me, made me a man. So like, I have to say a few things about him. And
okay, so
next week's Gramps one. The next 2 are my tribute to my grandpa, and it's going to have some information. And then I have one, and then the episode after that's going to be a dividend kings, aristocrats, achievers, contenders, all
We'll
that.
probably go over the list of what makes what each category. And the grandpa episode is going to be really important for those of you who are afraid of outliving your retirement in your retirement years.
Which is ironic because I swear to God, the fuckers are monitoring my email. I literally, we
were just talking about
this email went out last week, and I just got a thing yesterday that had the exact same information in it from I forget who it was.
Oh, you think people are stalking your emails?
I think they're stalking my email because like it can't be a coincidence that every time we discuss something in the podcast or I send the email out, the next week I get a publication that I subscribe to telling me the exact same thing that I already know because I already told you guys that.
That's actually really funny.
It literally is about outliving your retirement, how men live
longer,
less than women do. Men, it's like 8 years they outlive their retirement by. Women, it's like 18.
And
like,
Tim's grandfather lived to be 95. So that's well beyond.
He retired at 65 from the state of Colorado, had a pension, and like just a quick spoiler, what they're encountering now with pensions is the pension was originally established for 10 years beyond retirement. They figured
they're running out of money.
You die before, but now people are living like 20 to 30 to 40 years beyond their retirement age, and the pensions are like they're freaking out.
That's why the pensions have actually gone away, and I've wanted to deep dive into that one. But yeah, so that's what's coming up. We're going to talk about.
It's fascinating if you think about it, because I think we're all going to live like if you have no stress because your finances are in order. And your finances in order so you can afford like the good food that you need to, or the vitamins that you need to, or you could pay for like whatever of supplements you need, or whatever holy experience you need, whatever. If you have the money to pay for that, you're going to easily outlive your pension.
Totally. Absolutely. So
and Social Security, there's no guarantee Social Security to be around. So if that's what you're relying on, you're
going to shoot yourself in the foot.
You could be okay. We don't know.
Yeah.
You just don't know because the boomers are going to take a lot of security, and then you get Social Security, and then you have the Gen X. Then Gen X will take up the rest of it. So if you're a millennial or a Gen Z, I would not even rely on Social Security at all.
That would be me.
Because they've done research, and like I'll go over the exact details, but like a majority of boomers don't have enough money for their retirement, so they're relying on Social Security. And Gen Xers have nowhere near enough for their retirement with their 401k and their pensions, so they're going to take the rest of Social Security. Social Security, I wouldn't rely on that.
So that'll be a really important episode for any of you talking about retirement. So that'll be next week.
So that's why we do the income investing that way, because the income is generated every month or every quarter, depending on what you invest in dividend-wise, and then that's what you live off of. Your principal stays the same or goes up. Your principal is the same, goes up, goes down, whatever, but your dividends, what you live off of, is the income you're making from your money.
That is the goal. We want to set it up so that it's indefinite. Doesn't matter when you kick off.
And that's the beauty of it, because when you're getting ready to kick off, I think you can will your kids your brokerage account, your stocks.
Well, we will have to do research on that to confirm all those details. But I'm pretty sure there's some way, even if you're giving them the seed money and the plan to invest the same way.
You give them the stocks.
Yeah, that'd be really cool.
You can will them the stocks. I know you can. I know they can. I just don't know what the procedure is.
Apparently, death planning is next week's episode.
Have to. Gramps died. It was horrible.
So the takeaway for today, our call to action for you today is to go into your brokerage or into Yahoo Finance, run the screener with the metrics, do a little bit of research, see what you come up with, and start to feel a little more comfortable.
It's going to differ brokerage to brokerage.
Assess how you feel with the overwhelm.
And it's going to be like, if you go into Yahoo Finance, they don't have the exact same metrics, so you're going to have to tinker with it. Like, you'd be able to do the PE, but I don't think the PE to like 20 or less, I think it's like 5 to 10 or 10. Like, there's different, like...
Get it in the ballpark. It's just a starting point.
But those
Get comfortable with it.
The four main points are dividend yield, price to earnings, 52-week low, and 5-year dividend growth. Those are the four main points.
Yes, sir. You guys got this. Mm-hmm. We will see you in next week's
I'm going to go watch a movie.
Episode.
Dune 2 just came out. Dun, dun, dun.
Dun, dun, dun.